The following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome to the show. Wednesday morning. It's freezing here in the South. Not used to this. It's supposed to be 0 here tomorrow morning, or Friday morning, excuse me. That's just, it's going to break all kinds of records, and I think the high here is 17. I hate to throw that out there for you guys in Boston. You're probably going, yeah, that's great that you're getting down that far. But I know you guys have had a terrible time. That's just amazing what's happened up there. Oof. I tell you what, we're going to get right into some treasuries, and somebody actually just asked me about that. It was actually, I wrote it down, and I was going to look at the XLF relative to it and a couple other things. And I'm looking at the 10-year. I had this up actually before you mentioned that, the den, and we'll just get right into it, folks. Had our first breakdown, and again, just to kind of review my train of thought over time. Turn the rents the same way until we're told differently. That's kind of always the MO of using these profiles, and kind of the way I use them. And we always talk about using inflection points on a longer term basis and then kind of drilling down into the shorter term. And I just pretty much go right down into the 240s, and I'm showing that right now. So we're looking at kind of weeklies and dailies, trying to figure out the tone of what's going on with the long-term situation on any instrument. And then we'll drill down into the 240s, and this is the 240s on the 10-year. And the first hint of breakdowns on the shorter term started around 130.5 on the 10-year. And I had actually been looking at pullback support, first of all, considering that we're just going to kind of, work through something the same way until we're told differently. Around that 129.13 area was the kind of the first pullback support that we've usually been kind of playing that game until we're told differently again. We started a little bit of a breakdown there and closed below, and I talked about staying out of this marketplace on the long side until we tried to get into maximum support, which was around, and that was this week, around 127.23, 127.27. Now, I picked two battles there. This is from a personal standpoint because I actually do look at the treasuries religiously. It's been a great trade for the last couple of years, without question. But now we're getting into some technical damage. And actually some guys in Orlando had called me yesterday who have a pretty big floor there, and they do a lot of different things on that floor. They trade futures and do some penny stocks, and which I'm not a big fan of. But they also take some very large order flow from some big, institutions. And I'm talking, they'll get an order to get in and out of 100,000 shares of Google, get me out of a couple 100,000 shares of JP Morgan, whatever. And that's actually kind of a feat to get in and out of some of those stocks. But we were talking yesterday because, me and the guy that runs that shop, we spent a lot of time together in the 90s and the early 2000s. And, our train of thought was always, oh my God, these bonds and notes are too high. And that means that the inverse relationship to the rates. And we'd always kind of lament, even in 2008, it was amazing to watch the way the action was on the 10-year and the 30-year. And actually the 30-year went up 8 handles one day. I remember that. But anyway, we always kind of lamented about, the rates are too low. And then as this thing has kind of progressed forward since then, I mean, the Jimmy Rogers of the world making huge bets, and actually the guy from PIMCO making huge bets that rates would ultimately go back up, have been wrong. And as as soon as we started looking at profiles and just kind of letting it be black and white, blocking out one side of the marketplace, and looking at the relative trade of treasuries versus the stock market in general, as we've been talking about for the last year on this, or I haven't been doing this show for a year, but ever since this show started, we've been talking about, markets move up, notes and bonds move sideways, markets move down. Whenever that happens, on a very rare occasion, these notes and bonds seem to go up. So now, after talking to him yesterday, we were just kind of going back to the old days and trying to figure out where's the top in these treasuries and actually the bottom in yields. We started actually hinting that the technical breakdown actually would allow now at this stage, because we've broken down on the daily, and actually we had a new profile up here yesterday that we didn't really cover yesterday, but 128.04 kind of had the market open below that inflection point and then rally back up into a little bit of noise, rally back up into, I want to pick out some numbers here. 128.04 and 127.27 was that kind of DMZ, retraced back up into that DMZ yesterday. Now, so we tried to pick about just to sum up, try to pick about a 129.5 approximately, and then around 128. Those two were the lose a little, and then we've done the make a lot on a lot of these longs, and that's the way trading goes. But now that those two losses, so to speak, have happened, trying to pick that battle, now you're really, really in dangerous territory where, excuse me, where it's almost impossible to try to pick battles on the long side down here. So therefore, blocking out that long side of the marketplace for a change, first time in a long time, that's kind of the stance that he and I were looking at and considering. And what's the resistance area now is still that 127.27 into 128.04 on the 10-year. Now, do you short this? I think the only possible way to pick battles on the short side or wait for retracements back up into that DMZ. We've come down pretty quick here in a short amount of time, and I don't know about shorting things in the hole. You want to try to wait for retracements back up. And am I saying that the tone of the treasuries has changed and the long trade is over? I don't think so. I'm a little hesitant still this kind of has been the Garrett Morris trade, been very, very good to us in honor of SNL's 40th anniversary the other night. And I don't really see excuse me. Sorry about that. I don't really see this yet as being a runaway train on the downside. I mean, we're the 10-year's still, I think the 10-year's 2.6 right now? Maybe somebody can tell me the equivalent on the rate side. But what do you do with treasuries now on the 10-year? I think you just kind of wait and see on this. And if we get any more good economic or bad economic data, and the treasuries don't rally significantly, I think that'll be a telltale sign. So I think you got to kind of, at this stage, wait a little bit for some fundamental news to come out and see how these 10 years and 30 years actually act relative to that fundamental data. It's okay not to be in the market all the time, and we talk about that all the time. I mean, let the market come to you. And I think at this stage, considering that the batting average for this particular trade has been very, very high, and been very, very, I don't want to say easy, but it's been something to lean on along the way. I think it's time to sit tight with the treasuries, just kind of stay out of the market long or short right now, and just kind of wait and see how the treasuries digest the latest fundamental data. That being said, let's just move right into, so I don't think I don't think these things are a long or a short right now. Here's the 30-year. We're right at maximum support, and that's another reason I'm saying sit tight. I was looking across the board, across the yield curve this morning. I was actually looking at 5 years. We don't have time to get into that today. 144.08. We're trading 144.07. We've been as low this week as 143.25. So 30 years still kind of, sitting at maximum support on the long term. Here's the daily. There was that initial breach where it wasn't a good idea to continue to go long. We got the close below kind of retrace from 149.04. And again, it looks like we'll hold on 2 seconds here. Get somebody that continues to hammer me here. All right, so to sum it up, I think this is kind of a wait and see on these. I think the 30-year, you've got a possible support area here. But again, in summary, I think we just got to wait for fundamental data on these two particular instruments. I don't know if that's what you guys want to hear in the den, but that's my take. I think there's possibly some better opportunities without the guesswork involved as far as trading goes. Let me pull up the gold situation here because that's something on everybody's radar screen. I think I'm choking on my own spit this morning. All right, here we go. I apologize for that. Here we go. Here's the weekly situation. We got that kind of close below on the weekly, retracing that 34.38 area. And right now, I mean, I've been a big fan of going long this at possible inflection points, namely 67. Again, just like the 10-year, it's been kind of something we've been turning the rents the same way all the way up since we broke out above 1,200. Now we're back to 1,200. And I don't see a lot of leverage here. Tried another battle at 34.38. Didn't work out. Still not a big fan of shorting gold. So again, I think this is a wait and see. We got a new box that developed yesterday on gold. Those inflection points are 1222, 1245, and I'm not giving you a lot of direction on these two particular instruments, the 10-year, the 30-year, and the gold. I'm just saying I think we got to wait and see on both of these. And again, there's some other opportunities out there. Now we have been excuse me. Oh, for the last time, excuse me. We have been relatively bullish on the U.S. stock market, and that means looking at our breadth and looking at our S&Ps. And, again, there's no new information here on the way up, and that means there's zero reasons to try to look at this from the short side yet. The first, and we talked about this 240, and this is something that has been the make a lot instead of the lose a little on the treasuries and gold. So we found support at 2082. Now what do we do now? We've got 2094 up here rounded off. Any technical breakdowns on the 240s below 2082 are going to give you some opportunities against the long-term trend up from a shorting standpoint. But right now you've got literally support at 94 and 80. 82, 83. We'll be right back, folks.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzavento, Andy Hecht, Thinkorswim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. Sorry to be a little long drawn out on the treasuries a while ago. And gold. It's just that, these things are in transition, obviously. And, we were, again, taking a certain stance on those particular instruments. And now that stance may have to be changed a little bit. And we're just going to kind of have a wait and see here on those two particular instruments. Somebody asked me to take a look at the Japanese yen, US dollar, and these are the major inflection points, our weeklies, which are actually provided in the scanner. And as we look at these, that 120.42 area was that long-term target on the initial side was met with a high of 120.47, so almost to the tick up there. Now what do? We talked about looking at this from a long position standpoint only. And we've been just trying to turn the wrench the same way. Very similar to the 10-year situation where we're just buying support until we're told differently on a technically damaging basis. And we started this process, if you remember, around 101.33, and we haven't talked about going short this at all since then. All right. And that's kind of proof of concept that sometimes it's a good idea just to stick with what is being presented to you and don't try to outthink these things until the trend or the damage starts on the technical side, just as the 10-year and gold to some degree have started turning in that direction. Excuse me. So what do you do now? Latest inflection points. In fact, yesterday or the day before, we started talking about this as a very small, thin box. Now, there's a lot of different innuendos to read into these profiles. Some of them are, wide profiles, length of profiles, compression inside boxes, outside boxes, blah, blah, blah. And we could go, days on end on just that one indicator. The things that I see based on looking at three of our indicators, we're looking at Vega also. This is a red light, green light situation. As we have compressed down into, and this is very, very similar to the S&Ps. As you remember, we had our navigator just kind of compress and just rattle around into almost like a zero line with our navigator. At the same time, we were rattling around lower highs, higher lows on the S&Ps, and then we had the breakout. That's why yesterday and the day before we talked about not actually possibly trying to trade inside the box for any type of even short-term trading, selling against the long-term trend up or whatever. You had that opportunity yesterday with the lows of 118.24, bottom of the box 118.06, and the previous day low was 118.14, and that 118.06 obviously still the same inflection point there. We've gotten up into our top inflection point 119.44. Now again, what do you do now? I think you just kind of stay away from selling this thing. We talked about buying breakouts above this particular inflection point and buying support down at the bottom, and I still think that's the case. The close above here, just like we had the other day, and then there was a little bit of a stop out situation there. We still got to keep playing the same game on the Japanese yen, and they've had some fundamental news come out that, in my opinion, should have kind of put the brakes on this thing for a while for the devaluation of the yen. But again, that's why we're talking about the 10-year. Let's wait for some fundamental news to come out, see how the market reacts to it one way or the other, and then that'll tell us probably the new tone of the 10-year in general. Just as the yen kind of showed its hand there with that fundamental news that came out, that should have more than likely kind of relaxed this thing a little bit. But again, there's people sitting on the bid is what basically the picture looks like to me. And it still is a situation where I think you can buy with stops in force, and those stops in force on an intermediate basis could be below 118.06, if that makes sense. Keep the questions coming. We love to take situations and try to analyze them for you guys, try to make sense of them. That being said, let's just look at the next usual suspect, the dollar. Not a lot of change there. Still, in my opinion, this is a turn the rents the same way situation. And there's been some obviously great trending situations in the currencies lately. But this is where I'm orienting the stops below 93.67, and then actually able to try this again later if this is a complete washout down to 91.93 to pick a battle again. I hear the music. We'll be right back, folks.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how EverBank can help keep your money thriving just the way you want. Is growing your money a priority? EverBank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. Somebody asked me to take a look at American Express again and the utilities. I'm assuming UTIL means the utilities. Again, first breakdown, kind of like very similar to 10-year, 30-year situations. First breakdown, not okay to be long on an intermediate basis when we had that happen, but then you're coming down into kind of Custer's last stance here on the utilities, and this is our weekly support, which coincides with that former unfair high. Utilities. Okay, I don't know what that means. Utilities equals Dow Jones. I'm just looking at utilities right now. First, maybe I'm confused. I'm usually confused. Here we go. 591 unfair lows and former unfair lows, unfair highs around 589, and that's the long-term support. You could try to pick another battle here with the long-term trend still in force, but again, that's the last stance on this for the long term and the technical breakdowns. But you know, you're kind of not in a no man's land here, but you kind of, what we normally have is the 240 breakdown, then the daily, then the weekly, if that's going to happen, and that's the situation on utilities. I don't look at the Dow that much. I just kind of stay away from it because it's okay. DJU, gotcha. All right, well, let me. Okay, well, I'll just omit the Dow because you don't want to look at that. And let's just go right into AXP. We talked yesterday about this was going to be something that you're just going to have to wait and see. I still feel that way, even though we rallied like a freight train yesterday from the bottom. we talked about just kind of sitting tight with this and not that term dollar cost averaging or doubling down. I still think you got better situations out there other than AXP. And here's the 240 situation. We did have a new profile appear, which is a new demand area down here. And the inflection points that you can trade off of, by the way, now that they've appeared, 79.06, and then you've got some support down here also at 77.51. But again, I think this is kind of throwing the dice down here. There's obviously, in my opinion, better longs out there. And remember, if the market starts coming unglued, we could at any point start selling off with the S&Ps, and then that will be, some of those breakdown levels that we have been showing. But American Express, I think, this is just there's a lot of money changing hands with this particular stock right now. A lot of funds may have to start getting out of it, and that kind of happened the other day, obviously, after the earnings situation or some of the announcements that they made. And I'm still just kind of staying away from this thing. Not a lot to key off of down here. And when we have some new profiles up here, that'll be probably the time to relook at it. All right. Okay. All right, so another thing I wanted to look at, our XLE trade is doing extremely well still relative to crude oil, kind of going sideways. We talked about this. I just want to kind of state where we're at. 80.07 and 80.02 now are big time support for that. That's our weekly unfair highs and daily unfair highs now. So that's kind of where you can orient pretty cool stops around this particular product. And crude oil, let me just kind of hit that really quick before we move on. Again, 51.04, 51.56, there's the weekly numbers right there. This is all in the scanner. And here's our daily unfair highs. And it may seem pretty simplistic what I do every day with these profiles, but again, it just makes my life a lot, keeping it simple makes it very black and white to me of where to pick battles and kind of where to orient stops and where we've kind of broken through balanced areas and now are in imbalanced areas on the upside. So that's kind of the way I'm looking at crude oil, and the XLE has really shown that relative strength type trade available, and that's the way I'm looking at it. Somebody asked me to look at natural gas. I'm assuming the March contract is what you guys are looking at. Somebody, in fact, asked me the other day, could we get back into the 3.19 or 3.09? I don't know. I just know that it's technically still sitting. And again, we've talked about this before. There are opportunities to go long this on a shorter term basis. April. Should I look at April? I'll tell you what, we'll stick with March for right now, just because there's still some volume that we can look at with this. The March contract 28.16 is going to be, again, the barrier of entry on the longs. Getting a close above there, you could start seeing 3.03 up here. But again, stepping back and looking at what's going on fundamentally, this has been the most brutal winter in a while. It's cold as heck everywhere, and we should have at least had some movement with this. I know my mother's gas bill she complains about is super high, and she uses natural gas. Yeah, there's a lot of gas out there. All right, so let's take a look at a couple of stocks, and I want to look at GoPro again. And let me see where we're at here. If this is, let's see if this is pre-market 49.75. Okay, yeah. So 49.75 pre-market. And this is what happened yesterday. We had a new profile appear, actually day before yesterday. New demand area, new inflection point to key off of. And that was something, obviously, that was a launching pad for this thing. And what do you do now? So we're sitting, actually, yeah, that is the correct pre-market price there. I don't think that's a real tick. If you guys know anything different, I think that's not a real tick right there. That can't be. But anyway, pre-market 49.72. What do you do with this? I think you got some targets above now at 55.17 if you're kind of playing this game. And right now we're right in the middle of a fair auction on the daily. I had some questions about this because obviously it's in play. Here's the 240 situation. And not a lot of leverage right now, but some trailing stops to be put in if you're going to try to play this from the long side and continue to hold on to it. I want to look at the XLF really quick. Now, this has obviously been that yield curve dependent sector for the most part, and I was a fan of trying to get short this on the inflection points, namely last time around 23.94. This is what stops are for, folks, and it changed its tone, and now the yield curve is widening and the financials seemingly like this. So again, I think this is a no trade right now. Obviously this was something that provided some good opportunities for us in the past, but right now we're kind of gravitating above weekly unfair highs and former weekly unfair highs, and I think this is something you just got to sit tight with and wait for new inflection points to appear. I don't like this as a short obviously anymore past that 23.94 area, but I just wanted to give you an update on that as we try to update things that didn't work out. We're going to look at one more thing here really quick. We're going to look at General Motors. Some guys were asking about this. Yeah, let me get this bad tick out of the way here. This is long-term stops below 35.84. That's all I can say about this. I mean, we've obviously crossed some borders here, and new profile appeared yesterday, very wide. So we're going to have some volatility, and any pullbacks into that 35.84 coupled into 36. So around that 36 neighborhood is probably the buy point for this at this stage. I wouldn't just go in there and start buying it now. Kind of wait for a little bit bigger pullback on General Motors. And pre-market, we're trading 37.20, it looks like. Okay, so somebody's asking about AXP. Let me read that, and if you want to send me an email, I can maybe give you a little bit digestion on what you're talking about. It's hard for me to I'm a slow reader. I was in the back of the bus, and I'll comment on that if you want to send me an email on AXP. Okay. All right. We got to take a look at a couple other things. I want to take a look at not the healthcare, but the technicals. There we go. Technology sector ETF. Again, we closed below last week or above last week unfair highs. This is, obviously heavy NASDAQ related. So guys were asking about this. Should they buy this? I mean, for the life of me, the market's marched forward very quickly here. So is the NASDAQ. And if you look at this, we need some new information to key off of here. And do I think the market's going to go higher in general, the NASDAQ or the S&Ps? I'm just kind of basing my thought processes around looking at the breadth and looking at inflection points based on those indices. And I don't see any turns happening now. So therefore, sideways or north is probably what's going to happen here unless we start seeing some technical damage on the S&Ps, specifically in the first 10 of it below 2082. Now, what I wanted to do was pull up something that may be interesting to you based on what I just said. Oh, man. Okay, I got to relog into that. Let me pull up one of our Amazon servers here real quick, guys. Somebody logged into it. Okay. All right, so what we're showing you right now is Coca-Cola. And one of the things that we do constantly is we try to develop strategies on quite a few different instruments. And we try to use, and what I did with this, let me just show you some of the filters here. What I did with this, we have a lot of different filters, and we dragged our breadth into E-signal, which was a kind of endeavor to persevere on the programming side. What I've got is a weekly breadth filter to only go long stocks or short stocks relative to the breadth, but also keying off inflection points, some for highs, some for lows. And I've also got some exits that are pretty generic, other side of the box, taking profits, and also some breadth crossovers taking profits, and also have some entries based on breadth. And what does that mean? And we're looking at Coca-Cola. That means that looking at individual stocks, that this is Coca-Cola, it doesn't have a huge high beta situation right now with the S&Ps. But what we do to construct strategies, and I'm kind of going back to my point just a little bit here, is we try to look at these situations of, are we trading on the right side of the market by allowing our breadth? And we're looking at this on the bottom down here, and I can actually come in here and add, let's just say daily. Is my chart showing up okay? I'm hearing somebody can't see it. Let me redo the chart here. How about now? Does everything look okay? Okay. Sorry about that. So we want to try to use the leverage of the long-term market play in general, either the S&P or the NASDAQ relative to breadth. And I'm showing you breadth down here, crossovers, and then actually trading an individual stock relative to inflection points and that breadth from the long side or short side. Okay. And the green lines here are profitable trades. This is back testing, by the way, looking back in time. And as we look at these particular instruments, you can see that this one is kind of dialed up to trade on a little bit shorter term basis. And if you look at this, we've been able to use, and I'm going to actually kill the, let me kill the dailies here. We've been able to only take longs, for instance, when the long-term breadth, that's the way I have this strategy set right now, is positive, and only take shorts when the long-term breadth is negative. And that means that hopefully we're able to import something that's very, very useful into a strategy trading an individual instrument using leverage of the market itself. All right. So Coca-Cola has, and I'm just going to kind of stretch this out a little bit. This is our long-term chart of Coca-Cola. Coca-Cola hasn't necessarily, it's been all over the place, and it hasn't necessarily been a high beta stock with the market lately or in the past 3 years, which is what I have up right now. But looking at this is a little bit of proof of concept here. I'm going to go in here and I'm going to change our, I just thought you guys might find this interesting. Actually, we'll pick this back up after the break. I'm going to show you kind of how this works out.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi guys, welcome back to the show. I had Coca-Cola up on a type of a strategy, if you will. And I'm waiting for that to reload. And what I want to do is just pull up the S&Ps and talk about the concept of blocking out the one side of the marketplace really quick. And if you've been following this show, you know we've had some weekly breadth crossovers, especially to negative, in a very rare occurrence. And we've been breadth positive since October, on a weekly close, October 27th, actually, recently. And this particular strategy focuses on daily and weekly setups, basically, and also focuses on, as far as breadth goes, and also focuses on inflection points from those dailies. So blocking out one side of the marketplace, this particular strategy basically goes long only when breadth long-term is positive around those inflection points. So there's our daily boxes here, our daily profiles. Here's above unfair low, takes a trade long, exits on the other side of the box. That's one of the exit strategies, and then takes another long. And it's doing that based on, and there's that AUH above unfair high there, right there. And that was around 2052. And what we've got here is a long that's been on for a while. And actually, this is delayed that at like 10 minutes here. So that's the strategy there. And I'm going to go back to Coca-Cola in a second, but we took a long there. That was a loss. We took a long there. That was a win. And what this does really is the lose a little, lose a little, lose a little, make a lot scenario. And it's had trades that stayed in trades a lot longer. And we missed, these are on closing basis. So these are actually very handicapped executions, if you will, that basically have to wait for a weekly close to actually happen to use that as a filter. But as you look back in time, we always talk about risk-reward scenarios, risk-reward ratios. And what I wanted to do was show you a little bit of that's a crazy looking P&L graph there. But 66% winnings percentage and a 1.88 risk-reward ratio. So you're risking one every time to try to make 188 over time. And what I wanted to do is basically let you know that since the strategy itself, in my opinion, is very, very sound, we've also been looking at individual instruments using this strategy. And we've been doing this for the last year and a half here, using breadth and using leverage on one side of the marketplace to try to block out shorts or longs on individual instruments within these particular indices, like Coca-Cola, even ones that haven't really, had a lot of market beta, if you will. And that's actually produced some really insane, fantastic results, and proof of concept is there. So we're going to be, I'm actually finally going down to see Tom Sunday. I'm actually going to send him a ticket to verify that actually is going to happen this time. And we'll have a lot more things hopefully to show you guys and to be able to look into based on some automated strategies that we've been working on. All righty. So I want to go back to McDonald's really quick on the close here. Some guys were asking about this. 94.12 is somewhat support on this. I'm not a big fan of going long this stock. I'd rather look for breakdowns. And here's the weekly situation. We closed above. We kind of gravitated down below. I'm a big fan of actually being short this stock with stops above 94.68. The market's kind of dragged this up lately, but I feel like this is a decent relative strength trade and the ability for this thing to kind of drift lower. And again, 94.68 is where I'd orient stops on this particular stock. And we're trading 94.21 pre-market on this. Getting below 94.12 is going to be able to kind of validate that concept on 2 time frames. Thanks, guys. We'll pick it back up again tomorrow.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.